Welcome to Inside the Franchise Growth Engine presented by Hex Growth, a firm focused on building predictable pipelines, scalable growth systems, and enterprise value for emerging brands. These are real stories from real operators, founders, and growth leaders, but we go deeper. Inside the Franchise Growth Engine, leaders unpack the systems, financial decisions, and operational discipline that transforms growth into enterprise value. On today's podcast, we're excited to have Mike Maxson. Mike is a partner at CRI Simple Numbers, where he works with entrepreneurs to improve profitability, labor efficiency, forecasting, and overall business performance. What makes this conversation interesting is that most business owners spend a tremendous amount of time focused on revenue growth. Mike helps those businesses understand the numbers behind them, and more importantly, how to turn those numbers into better decisions. Thanks for joining the podcast today, Mike.
Yeah, absolutely. Thank you for having me. I'm looking forward to it.
Thanks, Mike. Mike, so can you give us a brief overview of your background and what led you to help entrepreneurs improve business performance?
Yeah, I have sort of a weird journey here. Born and raised in Erie, Pennsylvania, and I was a baseball player all the way through college. And probably like my sophomore year, I was getting an accounting degree, and I'm just like, I cannot sit behind a desk. No way. So I decided to join the Army. Like, what better way to go have some fun, And there was a lot of stuff going on, obviously, at the time in the early 2000s. And so I decided to join the Army. And while I was in, I got my MBA. And I always wanted to be a business guy. I just didn't want to sit down when I was 21. And so I decided to, pursue that and really worked for a government contractor briefly as a business analyst, and then got hired by Crabtree, Rowan Berger to manage the firm as we grew to grow and scale. And then we were merged in with Carr, Riggs and Ingram and changed the name to Simple Numbers as a portfolio company because of Greg's book. So from there, kept doing my thing and built up my client base, and now work with roughly about 50 different businesses across a bunch of different industries, ranging anywhere from 1 to about 50 million in revenue.
That's awesome. You mentioned you work with 50 different businesses across multiple industries. What would you say is the biggest financial misconception you see business owners make?
Yeah, man, that's a tough one because there's so many. One is that, sales is the driver of everything. And really it's at the margin. Obviously we all need sales, but a lot of business owners forget to get gross margin right. And in the Simple Numbers principles that we work with our clients on, is step one is getting gross margin right. We do expect you to go get sales. That is numero uno. However, from there, it's at the margin. All business starts at the margin. And from there, you begin your analysis.
What would you say that those same owners tend to focus on that don't actually move the business forward? I mean, I know there's probably 10 of those things, but maybe top 3.
Yeah. So the first thing is failing to understand how much gross margin per labor dollar that you need. And so we get busy, so we just hire. And understanding that, hey, in order to hit a profitability target, you do not need to understand that, hey, per labor dollar, I need to get a certain amount of gross margin. The second one is the OpEx side of things, where they just, hey, I'm going to cut sodas, and that's going to save me money. And it's like, well, really focus on the margin, the labor productivity, and any return on investments, which is the third one, which is your investment in marketing and the return on marketing and having effective versus ineffective marketing spend. So those are really the top 3 there that, you kind of run into, that they get focused on outside of those things, where, like I said, you're just worried about things that, don't really move the needle.
Monica and I are very much into franchising, and I'm actually a franchisee as well as a master franchiser for a brand. And we do look at gross margin per labor dollar. In fact, we were just looking at that last week because we do know that if you're going to hire in our world a new barber, we need to know how much they're going to contribute on an hourly basis based on what they're being paid. But not just that, the expenses, right? The OpEx, the operating expenses associated with having that barber there. So yeah, that's great.
And also too, I think we talked about this on our previous calls. Many entrepreneurs they know their revenues, but they struggle understanding the profitability of their
Mhm.
business. Why do you think that is?
Well, a lot of times there's a lot of noise on the P&Ls. In our simple numbers format, I'm going to tell you how we look at our P&L, and I'm about to break down a P&L right now for you. Get ready. Revenue minus non-labor COGS gets you your gross margin. Your gross margin minus your direct labor gets you your contribution margin. Your contribution margin is the cleanest number on your P&L. That's what you have left to run the business. We break down your OPEX into 5 operating categories of facilities, marketing, management, labor, payroll taxes, and benefits, and then a catch-all bucket of other OPEX. After that, it's net income. Well, net operating income, and then you have your below the line items to get net income. When you look at a lot of entrepreneurs or business owner P&Ls or company P&Ls, I mean, 2, 3, 400 lines tracking all kinds of stuff. And sometimes, I mean, it takes an hour just to decipher through in there what's good, what's bad, what's not, rather than focusing on the key components. And we talk about revenue through contribution margin being the business engine, meaning, hey, there's more things that can go wrong here. So your main levers of revenue, margin, and labor, and then your chassis, right, which is more fixed costs, either choice spends of running the business. But usually the issue is in your engine. And you find a lot of people focused on the chassis. And so, yeah, you can have too big of a chassis for your engine to pull, and that's pretty obvious. But focusing on the engine, sometimes you'll see so many lines in there, so much noise that they fail to be able to focus on it.
And I know that a lot of businesses, labor is one of the largest, expenses, right? And so, why do you think so many operators struggle to manage labor efficiently?
Well, one is the first thing you have to do is understand that, hey, when I was most profitable, where was my labor at? You just said you look at gross margin per labor dollar. If I looked at your P&Ls and I said, hey, on a rolling 12, rolling 3, maybe rolling 6, where was my best profitabilities? We call it your Olympic best. Where was that labor efficiency hovering? And was I doing good? And how did my team feel during that time? And you begin to look at that across time and hone in on like, hey, this is where that number needs to be. And so what happens is that we get busy, and the idea is oh, I'll hire to fill that. And then you get away from the right person in the right seat doing the right thing at the right rate. And next thing you know, you've overshot your skis on the labor rather than understanding that, hey, I need to keep it within these parameters of labor. And they end up, just getting out of that. It never happens when things are flat or stagnant. It's when the growth happens and we get overwhelmed and we forget that, hey, we got to pay attention to that number and understand that, hey, our team can actually perform there. It's done it before. We have tons of history, but I just overhired. And so, really trying to keep it between those lines is where they get out of it. It's always when they get busy.
And in my business, so because you threw it out as a hypothetical question, for us it's somewhere south of 40% of gross revenue is our labor cost, and when we're there, we're 37-38%. We're looking at really much more solid net profit numbers. I can tell you that there's at least two levers to pull there, right? You can either increase obviously the production of each individual employee, or
Mm-hmm.
you can shrink your talent pool until the capacity or they're at a place where they're actually producing enough to then hire the next person. I think that's probably not saying it absolutely the right way, Mike, but I just see that in so many of our franchise businesses where they overhire on these barbers and artists. And I'm like, if they're only at 20% booking for the day, they shouldn't be at work. You should shift that. You should shift those services over to another provider to make that person even more busy. So you're actually, again, driving up the gross margin.
Can I ask you a question?
Yeah, for sure.
Do you have, we talk a lot about financial metrics, but one thing I love when we're looking at this, and I hate to break it to people out there, but all this requires actual management and understanding that, hey, what is actually the capacity of my team? Do you have additional metrics that are outside of financial metrics, but relate to financial metrics? That makes sense. For example, we'll have a retailer be like, hey, I count door swings. If door swings a week are 5,000, we are hot right now.
Yep.
right? Do you guys count additional metrics in addition to that? I'd love to hear that from
Yeah.
entrepreneurs about if they count additional things
Yeah,
like
we do. I come from Silicon Valley, so I run my barbershop, my high-end barbershop, like a software company, believe it or not. And
that.
I
Oh,
have
good.
actually boiled down over the last 3 years as an operator 20 key performance indicators, KPIs, that are separate from our financial or balance sheet or any of that stuff, P&Ls, that we track from a KPI perspective to know
Awesome.
the health of the business, right? And so
Yeah.
my team and I, and this is not uncommon for me, we actually meet on a weekly basis, 3 hours, 2 to 3 hours, to review those KPIs and make adjustments on those, make adjustments to the business to impact positive change. If we were slower, for example, new guests, we were slower 2 weeks ago. I'm just making this up. 2 weeks ago, we
Hmm.
probably need to look at to make sure that we have enough barbers available on the busy days that new guests, people that want to give us a try for the first time, they're available to take them in, right? So there's all of these different things we measure, but yes, we do measure those, and we've been doing that for
Awesome.
the last 3 years.
Yeah, that's great because I think sometimes, and again, there's a lot of noise in financials, but sometimes it's those other ones that relate. And then when you hit those interesting metrics, like I said, door swings of a retail company, well, then it's like, whoa, 5,000 door swings we've had the last 2 weeks. Well, come back to your financials. Like, where does this relate to our current labor situation? And then get into the numbers. Sometimes that helps too, right? So,
100%. I mean, you get a big investment into these businesses, right? Like you get a business rocking and rolling, and next thing you know, you have a $2 million, 3 million, five, whatever, and you've have invested all this time and money. It's mind-boggling me just sometimes when I talk to business owners and they don't know their financials, or they don't
mhm.
understand the KPIs, and I'm like, this is your livelihood, man. Like you or lady, like
Oh yeah.
you got to get this
Hmm.
right. Yeah, you got to get
Yep.
this right. Yeah.
And speaking of growth, how does your company, Mike, help business owners balance growth and profitability? And then at what point does growth become dangerous?
Yeah, so I like to frame it this way. It's pretty cheesy, but it works. It's the 4 A's of analysis, alignment, action, and accountability. And so, first of all, you got to have the analysis that lets you know, like, hey, where are we at profitability wise with the current labor at the current margins? From there, are we aligned on what actually are our levers that we can pull to make a difference, right? You don't need a member of your leadership team, like I mentioned before, over here on cutting sodas. The next thing is then taking action on those things because it has to actually happen. Like, hey, we need to add labor or fix our sales department or whatever it is. And then from there, holding it accountable to are we actually doing it? So measuring that forecast against actual production and seeing that, hey, are we off or were we not? Where growth, I guess, can get dangerous is when though one of those things are off. And so if you don't have alignment around the KPIs or alignment around what works, you're then growing and just like we just talked about, you're hiring over here, you might be cutting over there, you're just spending money. Hey, where does my OPEX percentage need to be? Or where do my, and you're going back to things you should have done in the beginning. Like you don't need, if let's say you're a $1 million business, please have your books fixed before you're a $10 million business. Like we don't, here at Simple Numbers, we're a consulting firm, but we do accounting as well. We do taxes as well. And we make a lot of money off cleanup projects, people, because we get businesses that didn't address their bookkeeping and then they come to us and they're 10 million and we're fixing their balance sheet. We're reconciling loans that haven't moved in 3 years and they have no idea how to predict cash. And so those are getting off on those four things makes danger because growth is always good from a high level standpoint. But when you get off on those things, then it's just the wild, wild west.
And where does that generally come from? Because I do hear of that often, where the books are just not fixed. Is it, and I'm not pointing any fingers. I'm not
Oh,
trying
of
to say,
course.
right? Is it just lazy bookkeeping?
I don't know if lazy is the right word as it is improper leverage. And so one of the key words I love to use with my clients is, are we leveraging our labor properly? And what I mean by that is, hey, you stress that labor efficiency, you push the team to produce before you make your next hire. Well, one of the areas that always seems to get over leveraged is the bookkeeping side, meaning that, hey, I'm a new entrepreneur, small business. My mom used to do bookkeeping, or my my wife's sister's cousin's brother's uncle, used to do it. And next thing you know, they're okay-ish, but not when it starts, the transaction volume really starts to sink in. And next thing you know, they're growing, they're big, and the person's like, man, I am overwhelmed here. I've never been a bookkeeper at a growing business. And so they're just over leveraging that position. And I would tell you that, hey, if I was tomorrow starting a new business, a good bookkeeper would be one of my top 3 ads right away.
That and a CFO, when you can afford it,
Yeah.
I go to that immediately. That's like one of my first 2 hires, is just making sure you have
Yes.
a quality bookkeeper. And then when you actually start to grow and you need better financial controls and cash management, even if it's fractional, just get the CFO
Yeah.
on
Oh, yeah.
fractionally. Yep.
Yeah, well, by the way, that's a great point for all you business owners out there. The fractional world is, and I'm not just saying that because that's my life here, but but I mean that for all your positions. If you want to talk about leveraging your OpEx, fractional marketing or CFO support or HR support, rather than sinking your teeth into a full-fledged hire. And let's face it, if you're a $3 million business, there's only so much HRing to do, right? Is it a 40-hour a week job? Probably not. Maybe even, I'll get the famous, I got a marketing manager. It's like, well, you're 2 million. Is there enough marketing managing to do? An outsourced firm might be able to help that. I mean, so think of that stuff too, to help control costs. And then if they're not good, you just get rid of them and hire a new firm. And it really helps.
Yeah, I don't want to get too deep into that. The next point to that is understanding what your corporate annual goals are, and then working backwards will tell you exactly which positions you need to hire there, right?
Correct. Yes, exactly. Good point.
Yeah. So you spend a lot of time helping companies forecast, future performance. What separates businesses that consistently hit their targets and from those that actually just don't? They miss it.
Yeah. So one of the things in our Simple Numbers book that we have a lot of explaining to do on with people new to it is budgeting versus forecasting. Budgeting isn't a bad thing, but everyone usually does a budget, then throws it in a drawer and checks it like once a year. And we believe in rolling forecasting, that in every time and every month or whatever your rhythm is, you reforecast and reproject. We say the worst case quarterly to reproject. Best case, you're reprojecting monthly, because what you start out with in December when you do your annual planning for the next year, I guarantee you it's not what it looks like in June. Maybe you're one of the people that are spot on for some reason 6 months ahead of time, but business does not move that way. You guys know this. And so the people that are able to do it well reforecast and reproject consistently, at worst quarterly, at best monthly.
As you know, a lot of our listeners are business owners, right? Whether they're franchisees or just multi-unit owners. What financial disciplines should they establish before they begin to scale?
Yeah, we have the wheel of simple numbers. It's one of my favorite graphs we have, and I'm not a big graph person, but the first thing is you always got to be assessing the market for profitability and scale, right? So, is this a market right now for me that allows me to push on the gas as hard as possible, right? Think pre-COVID, think during COVID, prior to the inflation, prior to high rates, all that stuff. The next thing is, have you eliminated any low value or loss activities from your business? Are you doing things that are just not worth it, not at the right margin? The next thing is are you profitable with what you got? Like right now, are you at a profit target? Because if you're at 1% profit and you just like step on the gas, you're going to burn out of cash real quick. So like in simple numbers world, you got to be a minimum of 10% profit to revenue. If it's gross margin, 15% gross margin to revenue. The next thing is get capital efficient. We want 2 months of operating expenses plus labor. And that's a fully capitalized business. And then the last thing is, do I harvest this cash, or do I make my growth play? Those are the things that a business needs to master. And you're always going around that wheel. Sometimes it's fast speed, sometimes at a slow speed, depending on where you're at. And you're moving through that wheel every time. Hey, what's the market like? Am I doing the right thing? Am I profitable? Do I have the cash? Boom, go for growth. Or whoa, the market is not good right now. I'm going to harvest this cash, build up a nice nest egg. And then when the time is right, bam, make my growth play.
When you look at a business for the first time, what tells you their management truly understands its economic engine or not?
Yeah, back to the sort of alignment thing is, you have a management team that might not meet regularly on their financials. you have no one owning a certain part of the P&L, meaning that like, hey, no one's really looking at revenue, or this one person's just gung ho about operations. That typically is where you see it is the ownership side of each area. And I always say that if you're going through any strategic planning, if anyone's worked here with a business coach, I'm sure you all have, or with one or part of one. Um, one of the things they do is the ownership of your leadership team on certain areas of the company. And that's why you see owners sometime when they're growing, they're real overwhelmed because they're owning the whole P&L. And then as they grow, the CEO or the business owner needs to begin to gravitate to their highest and best use, and other people need to begin to own different levels of the P&L. So sometimes you get in there with clients and, oh, well, we haven't really paid attention to sales too much. It's like, what? It's like, why are you doing that? And so you get into that area of the lack of ownership around, and not in a, like they're doing it on purpose or a mean way. They're just, their focus is not there and they haven't been aligned on that.
I've worked for enough early stage companies to know that the founders and co-founders usually want to hold on to certain disciplines too long. And at some point they actually need to bring in the experts in that functional role to do those jobs so the company can grow. How do you, I always struggle because I usually come under as the sales discipline, and I'm like, okay, founder, like you've been the best salesperson up to this point. You've taken us to X amount, and now it's time to bring in a team that's actually does it for a living, that's professional at that. And how do you have those hard conversations with?
Well, first you start. I would always. This is. I'm just going to throw out a revenue number here because it's common in my experience. Around that 1.5, 1.6 million in revenue, you begin to see the landscape shape up of the owner founder going to their highest and best use. Meaning, there you see them beginning to gravitate towards, like you said, maybe a sales and they're good at it, or maybe you see them really operations focused. And when you see them in the discussions we have with our clients on a monthly basis, and you start hearing the discussions, and I'm like, man, you're really focused on operations. Is this what you like to do? And they're like, yeah, man, I love just overseeing everything, making sure it's working, being involved. And I really don't like sales. And it's like, well, we need to then get somebody to do that and then carve out that role. And so you hear the words and you see where their involvement is. And I'll tell you, I get this question all the time, Dawn. So thanks for asking it. Is what's the best kind of owner, founder, CEO to work with? And typically it's the sales focused one, because that guy, that guy just wants to run off and sell, man. Just go. Like, just let him
leading you to that answer, Mike. Leading you to that answer.
I was leading you to that answer, Mike. I knew you saw it coming from a mile away, but yes,
I did.
Right. Yeah,
I did. Yeah, and that's the best one, man, because they're just like, you just wind them up and you're like, go. We can take care of everything else, because there is nobody who sells better than the owner. And if you got an owner, I'll say a secret to business, if you got an owner that can stay the main salesperson until about 10 mil in revenue, and then bring someone along as he moves up that way, or brings a team along with him, man, that is gold right there. I see a lot of owners trying to break away, and they're even sales. They're really good at it. And then they're like 3 million in revenue. They're like, I'm going to stop selling. It's like, why? Just keep doing it. Like, just go until you can't anymore. So yeah, good. That was good. I'm glad that worked out.
Yeah. Well, the reason being is that I've worked for enough either operations or engineering founders, and I'm like, you can't, no matter how hard you try, you cannot operations your way to 10 million in revenue. Like, you have to invest in growth. You have to invest in growth at some point. But they for some reason, and I don't know why, but I think that they're scared, or they don't feel like they can control it, or whatever the case may be. But Monica and we've experienced that before. Yeah. So,
God, there's no problem like a sales problem. Please give me one, a good one. Like, there's so much sales.
yeah. Where we're closing too much. I'm like, just keep going. So
yeah.
What are some common habits that you see consistently among top performers? I know we kind of talked about the opposite, but among top performers.
One is they are very focused. And this is me. I'm on the finance side, so let's talk financially. They're very focused on what those numbers are. There isn't a billion things. They know like 3 things. that, hey, if these things are humming like this, we're good to go. Very aligned on that. The next thing is routine of meeting. Dawn, you said it earlier. Hey, we meet weekly. Well, I don't care what it is, but if it's frequent and you're meeting and you're going over, hey, what is okay, this leads to it, the sales pipeline. Like, where is our pipeline at? Are leads coming in? Are we talking to people, or door swings, or whatever you want from that side of it? They're meeting on that regularly. And then they're always revisiting that forecast and making sure, like, hey, are we on track? Are we not? And if we're not, how do we adjust? And if we are we then doubling down on the efforts to do it? So, hey, for example, you found a marketing channel that's working. And if you're not meeting, and here it's doing okay when it could be doing great or could be doing even better, I mean, that's a killer. You missed you missed a huge opportunity. And so it's those things right there of, hey, what works? What are the frequency of us looking at all of this? And then are we then taking action on those things by revisiting the goods and the bads of it in that process? And they're rigorous in it. My best clients are almost fanatic about meeting and reviewing those numbers.
Because I think as you start to expand, the CEO and senior leadership team, they get further away from the trenches, and you're just now sometimes interpreting numbers versus sometimes it's good to hear anecdotally or even real life, like actually this is what's happening in the trenches with that sort of middle tier management team. Because I actually show it down in my organization. I show it down all the way down to like my barber lead and my nail tech lead, not because I want them to be masters of the finances. What I want them to understand is that wherever they go next, if they understand this, they're going to be so much more valuable to that next owner because they understand how this works and how to make decisions based on those numbers. And I think then, moreover, I think the next sort of jump for an organization to make is for those critical folks that are helping to manage those numbers, making sure that their comp plans are aligned with the performance of whatever they're trying to achieve. And I think that's one that I think I see missed a lot, which is people will say, Don, and I'm going to brag on my general manager. It's not me. My general manager has been running my shop in Westport, Connecticut for a year. We're consistently top 3 or 4 in the nation out of 70 locations. It's because her comp plan is directly aligned with the performance of the shop. And the more the shop makes, I love when I have to pay her out a $5,000 bonus for that month because she managed payroll, she drove more people in, net margins were there, and she's making a ton of money. Great. Good on her. So,
and you just explained labor efficiency concepts.
Yeah.
That's it.
I think they miss it, though. I think a lot of owners miss that, tying it in, and it doesn't need to be soup. That doesn't have to be grossly favorable to the employee, but I think when the employee sees, okay, I'm making a good base salary and I can make another $1,000, $2,000, $3,000, $4,000 a month based on, of course they're going to, the right person, here's the key, the right personality will take advantage of that situation.
They have to know what they can control to make more money. Yep. And we sometimes, I see people, bring things to their employees and it's like, your employee can't control that. Like, this is what they can control. Show them what they can control. And if they control it to this level, they make more money. And we oftentimes have people bringing up things with their employees that it's like, hey, they got no say in that. And so just show them what they can control and show them how it makes a win for them. And it's a beautiful thing to watch happen.
I can't believe it's already 30 minutes. This has been good.
I know, that went quick, real quick. I got to have you on our Simple Numbers Profitability Playbook podcast. I would love to have you on if you're up for it.
Yeah, I would love to trade the favor. I even actually, if I don't know how to share my screen, but I'd love to share my screen and show you the 20 KPIs and actually go back 3 years. You can see, and what's nice about that piece, Mike, is that we can say what happened in Father's Day weekend or the week leading up to Father's Day last year. And we look at those KPIs and we're like, okay, great. Now let's dig into our schedule. Oh, that's what we were doing. That's why we sold so many gift cards, or that's why we were so efficient. So then it's easy to replicate. And when you don't track those consistently in a place that everyone has one master sort of source of truth, it makes it hard to do that trend analysis, right? I mean, I know that there's technology out there to do that, but sometimes you just want to look at back of the napkin, like what were we doing last year at this time?
Oh yeah,
right.
Yeah.
Yeah.
Consistency, look at it, address it. I mean, it's not rocket science sometimes. I mean, sometimes I've met businesses that have done great things with, I would call it some of the most amateur stuff, but they meet on it, they're regular, they believe in it, and it works.
All right, Mike. Well, if you could give one piece of advice to every business owner listening today, what would that be?
Yes. The key word will be leverage across the board. I love saying it. Leverage your labor, leverage your team, leverage your expenses. Don't get wild, measure it, and don't think that, oh, because we're busy, we can't do it. So we just add all these things. It's like a lot of time your team can do it. Your business can absorb it. You might be set up for it already. So, when you're able to then do that, you're able to then achieve growth, because a lot of people don't understand that as you're growing, you need the cash. Profitability gets to cash. And so you got to be profitable, and don't overextend yourself without reviewing everything. And that prevents you from getting that, again, 10% profit to revenue, 15% profit to gross margin is what you want to target for a healthy business.
And I would say, Monica, you didn't ask me, but I would say, because I work with so many different franchise owners, don't be ashamed if you don't know the numbers. Remember, I'm a sales guy, but I think you can tell that because I pay so close attention, and over the last 3 years, I'll go to guys like Mike and say, Mike, explain that to me. How does it work that way? Why? And then you become more knowledgeable. You feel more confident about your business, because when you can look at your P&L, your balance sheet, and understand what's going on in there, or if your chart of accounts is not set up properly, like when you have that level of discipline and you feel confident, then you want to meet on a regular basis to have those reviews of, financial reviews. So yeah. Do you want to tell us where folks that are watching can get a hold of you?
Yeah, absolutely. Mike.Maxson at simplenumberscri.com. Simplenumberscri.com is also the website. We have the Profitability Playbook podcast. You probably, I hate this, Google me, and I'm kind of out there. I'm not like a big deal or anything, but seriously, we put out a lot of content, and we have, Greg, our CEO, with the books and everything. So we're out there. So you put simple numbers in anywhere, you're going to find us.
Thanks so much, Mike.
Hey, you're welcome.